So we're back for part 8. Well done if you're tuning in on this video. We talked about psychology in the last video. I just want to add a few more points to that before we get going, because I want to know why ICT traders fail. So you see a lot of people bashing ICT, why they fail, but that comes down to 3 things that I've nailed down. So one is your psychology. This happens with all traders, no matter what technique or strategy you are trading. So psychology, there's a lot to this, and the only way you're going to develop your psychology is by journaling and spending time in the charts. So key point there. Also, it's knowing the basics of sort of like market structure, but not knowing the context of the market, meaning high time frame bias, and I'll go into it in a minute, but how you could be wrong, for example, and higher time frame PD arrays. So knowing the higher time frame PD arrays and general direction where price is going to go can indicate, for example, where your turning points are and where not to get involved at the market. So for example here, look how this wick comes down to that PD array that I highlighted. Okay, and you don't have to believe me, but I had this highlighted in the zone beforehand. Okay, so I know once it hit that, that's a potential reversal. So we're waiting for that reaction that occurs there. Okay. Where were we? So trading retail patterns can become synonymous with ICT traders, meaning that if you don't have context, a breaker, for example, that I've showed you in the previous video, can be manipulation, meaning it's not an actual breaker, it's a fake. Yeah. So you have to pair that with these levels here. Yeah. Know where the relative equal highs are, know where the price is going in order for ICT to work. So I'll go back in the chart and give you some example. Okay, so let's just sum over the daily first for you. So what I've got drawn on here are the PD arrays that I saw relevant prior to this candle. So I was finished this day and I marked my chart up. So you've got this wick. I did quadrants on it. Okay. Then below this wick, you have this volume imbalance. Okay. And, which we'll talk about in the next video, the low of the week, if we're bullish, would happen on a Monday or a Tuesday. Okay. Unless there is a reversal on Thursday, which we'll go into on the next video. Because Thursday can sometimes offer that change in delivery. Usually Wednesday will continue with Thursday. The low of the week will be made on Monday or Tuesday if we're bullish. Anyway, back to what I was talking about. So these high time frame PD arrays will be key for me when I'm trading on that day. If you're not using these, then you're basically trading without a map. Yeah, you want the map, you need the map. Yeah, it's like trying to navigate yourself to a destination, but not knowing where you are on the road. Yeah, that's what you're trading. You're trading blind without looking at these high time frame PD arrays. They're very key. They're very important. So if we drop down to the 1 minute and we go to Asia. So whilst you're here, look at how when we come through this first upper quadrant, we just trade straight through it. Yeah. So we've traded lower, 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 lower. Look at all the bodies really struggling to get above the consequent encroachment of that wick. Yeah. And then at 8 o'clock we get that macro time to trade lower. And you could have targeted, for example, this level here, which is, let me just go back to show you. Just a new week opening gap. that is this volume imbalance here. Okay. But it comes down to the next one. So you could have took your profit the first one because it could potentially have reversed from there. But again, so I'd have took profit here. And again, we're not expecting that big reversal because we're not at a macro time. Trade down to the volume imbalance here. 10-10. We're outside of our kill zones, so technically I wouldn't have been at the chart. But when I turned up for the next kill zone, I know where price is going to go because we've had that strong reaction here. Or if you're getting in at midnight, you know where price is going to go because you've had that strong reaction off that PD array on the higher time frame. So now we're bullish on the week. Where's price going to go? It's going up. Okay, so example. I don't think you'd have been wrong to perhaps took this trade at a macro time here to go higher. Yeah. But what I would say is you'd have had to move your stop up. Yeah. So I could have potentially saw this as a reversal, which I don't think would have been wrong. If you take the low hanging fruit objective, like with your highs, or if you just trade up to, because why sometimes when you look at trading, you can't trade from liquidity to liquidity. That's a higher skill than if you were to trade from liquidity to inefficiency. Yeah, so that's the top inefficiency on the chart. So it reached the inefficiency, came back down. Okay. So sometimes it won't take the highs. Yeah. But again, if you're entering here, you would have moved your stop up as this moved away from you. Okay, so there wouldn't have been losing trade, but I don't think you'd have been wrong in your presumption to get that reaction off that PG array there. When it comes back down, you get a bit more of a stab in it, so I could be more sure of it when price moves away from that high time frame PG array. But notice, let me point out something here. If you're not aware of this level, then you enter into this fair value gap. Oh, we've got a fair value gap. We've got a market structure shift in a macro time, 3 o'clock. Then you're entering here and it's trading against you. This is why people will fail at the ICT concepts, because they're not taking in context that higher time frame narrative, which is we're reacting off this level. Yeah, I wouldn't be interested in selling until we got through that level. Or if I was only selling down to that level because that's where it's going. Then we get the reaction and numerous places to enter all the way up throughout that for a move. It's what you could have caught, because now at least until 7 o'clock we're in. So we've got, in terms of the AMD model, which we spoke about, accumulation here, manipulation here, and then distribution high. Yeah. You've got to wait for the key times. So if you're here in price and I'm waiting around this consolidation, what I'm technically looking at is for price to stay below this line. And it crept up a couple of times, but ultimately when we break at a macro time, 7:50 to 8:10 in the evening, it comes lower. Then look, we enter in this fair value gap and we can target this low or this low. Yeah. Okay, and if you enter in there, personally, what I'd have done is if price comes down to this level, I would have moved my stop to break even on this level here. because I was mindful that this could have been a reaction zone as well. Okay, so that's the way I sort of think about it. You've got to know that high type context bias, and you're not going to get it right all the time, which is why you build into your trading plan the ability to have losing trades. And when you start out, you're going to lose because you're not going to know how to interpret it, or you might get it wrong. For example, you could have seen these little breaks above as, oh, it's reacting off this level, which is the consequent encroachment of the wick. But it's not meaningful reaction. I mean, look how it's chopping around. If you got in here, this fair value gap, for example, occurring at the macro time, that market structure shift there, entry. But I'd have preferred the market structure shift and to come here and break above this meaningfully, but it fails to do that. Okay, see, I'm trying to look at context. So I was waiting, I'd wait until price would come higher, higher, higher to get that up, back up to these levels, but it didn't want to do that. It's chopping, chopping, chopping. Stay out in that, stay out. Wait for the next macro. And we get that plummet lower. So when it starts coming lower than this, that inversion preference to go higher is just completely nullified. And then you know, right, we're definitely going lower because it needs to move around. It needs to go somewhere. So we're not heading up, we're heading down. Yeah? We have to enter in the fair value gap though. We can't chase down here because we get stopped. You have to enter in that fair value gap with stop loss above this candlestick here. Yeah, so you have to enter there for it to go lower. And you might get a bit nervous here, but ultimately all it's doing is using the new week opening gap. And then look when it trades below it again, comes back up, fails to reach the top, and then plummets lower. This volume imbalance again comes up, hasn't finished the work. Could have potentially saw that as reversal, move stop up, break even, come down, tries it again, can't get below it. As it can't get below it, we're entering again, and then we're making big moves. Okay, that's the mindset I want you to start thinking in. If this is too much for you, don't worry, just watch my previous videos, take a step back, make notes on your chart. Again, it's easy. I'm not saying this is easy because I'm doing this in hindsight, yeah? What I'm saying is, the more you do it in hindsight, the more you're going to be able to predict when it's going to happen or what to look for when you do it forward. So you start with looking at the charts, then you move to back testing, and then you move to live trading. Because again, one tip for if you're live trading, don't look at the candlestick as they're forming so much. Look at the candlestick at the end of the formation. Yeah, the candlestick can make it look like it's going one way, but closes the complete opposite way. Because it's, again, each candlestick is going through that accumulation, manipulation, distribution cycle. So each candlestick's doing that. So if we know this, we know not to get trapped when it's, again, accumulation, manipulation, oh, it's going high, and then it literally reverses like one wick. Just literally wicks completely the other way. So you need to know this. Where were I? Back to the... Well, yeah, I hadn't even mentioned new week opening gaps. That's where we're going to get to with that zone before, which is the volume imbalance that it ultimately trades through, but then reacts off. So, bonus point, little tip here. When you're trying to succeed in this, everyone is not going to believe in you. Everyone's going to think you're crazy, and it's your job to prove them wrong eventually. Okay? So you're very lucky if you've got someone that actually believes that this is going to work for you, because everyone, when they see you either blow an account or they see you losing money or whatever it is, or any setback whatsoever, everyone's going to think you're gambling your money, etc. But you're not. You're trying to have the edge. Think of it like this. Trading is a gamble if you don't know what you're doing. Okay? So you're trying to learn the path of knowing what you're doing. Do you say that if you go to a casino and you randomly place a bet, are you a gambler? Yes, you are. But if you are the casino and you own the casino, are you a gambler? Well, in a way, but you have an edge. So I wouldn't say they're a gambler. They know over the long term they're going to be profitable. Exactly the same in trading. But without that strategy, without that mindset, without that, all the factors that it takes to become a good trader, being able to read markets through ICT concepts, then you are technically gambling. Yeah, I'm not saying you have to trade ICT. Some people have a small edge in just from their psychology, from that side of things that makes them profitable. But what I am saying is that if you know what you're doing, it's really not gambling. You are the house in the game. Okay, take that into account. Also, as well as this, I'm going to talk about the mechanical mindset that a lot of ICT traders have, which is that I need to have a mechanical model. So let's dive deep in this. If a model is purely mechanical, right, why don't you code it into a robot? Yeah, think about that. If it's purely mechanical and it can be coded into a robot, then what's the point of you being sat at your computer all day? Because I know how to code robots, and I'm telling you that it's not purely mechanical. Because the reason it's not mechanical is because it's more look at how many factors we are looking at here. Yeah, we're looking at every candlestick as it prints. If you can make a robot that can do that, maybe you're onto something, but I don't believe you can. So I don't believe you can code ICT into something that works for you, because you can code specific strategies, like for example, PJR gives you one, which again over like a year might work, which is the London sweep. So Asian highs get taken, and then London reverses through to the low of Asia, which we've talked about. But what I'm saying is it's nowhere near as good if you're a good trader, because you've got a better read on the market at that precise moment. Whereas if you're mechanical, you're saying X plus Y equals this. Well, if it's that simple, then why is either everyone not doing it or you're not coding it? Because there's a lot more to it than that. And I'm not saying that algorithmic trading doesn't work and people can't make money off it, because people do who are very good at it. Admittedly, I couldn't do it. But what I am saying is that algorithmic trading, I don't believe, is as successful if you were good at this. So you've got two choices. You could either go algorithmic and try that way, or you can try this way. And yeah, I've rambled on a bit of this video, to be honest, so I might have to make another one. But mechanical mindset is that I have my model that I'm going to stick to it, which you do need a model, as in like you need entry techniques, how you get into the market. But if you can't read price action, then, and you're saying I'm doing mechanical, every time it sweeps up through Asian highs, I'm going to try and sell. Well, that's not adaptable. So you've got to be flexible, adaptable with your trading. You can't assume that everything happens in the same way. Every time you have a market structure shift and a fair value gap, it's going to reverse. It doesn't work like that. It works off the basis of time and price committed together to go to your target that you've predicted based on a higher time frame PG array. See how that sounds complicated? Because when you start, it is. It's not as simple as there's a market structure shift, there's literally a fair value gap, it's going to reverse. No. Is it a key time? Have we swept a key level? And where is the bias of the day? Are we going down? Or the session, are we going down? You have to take these things into account. Right. I'm trying to inspire you by trying to allow people I'm teaching to not become sucked into the simplicity of it. The better you get at it, the simpler it becomes, because you're seeing moves before it happens. But without that knowledge and going through all my videos, or ICT's videos, or Shemaine Trade's videos, or Ali Khan's videos, whoever it is, you ain't going to see that success in the marketplace, because you're going to get trapped into trading like a retail trader. Yeah? You have to understand the full picture before you stop hedging your bets on it. And okay, that will sum us for that video, about 20 minutes long. So I said I was going to keep it 20 minutes long. We'll go through this in the next lecture, which I'm going to just full up make in a second. So yeah, we'll keep going with this, and we'll keep chatting. I'm going to add in the psychology as we go through, but next session I promise there'll be more trading concepts. But yeah, I need some more TikToks. Thanks a lot, guys. Have a good day.